you don't know if that's exceptional, if they're an outlier, if they're, they could have debt, that could be debt field. You don't know. And I think having the data gives you a little bit of like a base case so you can benchmark yourself. Going from 2 to 3 million doesn't really change your life that much, but going from 0 to 100,000 completely changes your life. Yeah, that's the level of dedication it takes. You need to do that for multiple decades to get to that level of success. Now, is Bill Gates happier than 99.99999% of people? Probably not.
Comment passer d'un niveau de richesse de bas à un niveau de richesse très élevé, qu'on passait de 10 000 euros d'actifs nets à 100 millions, 500 millions d'actifs nets? C'est ce dont on va parler aujourd'hui avec notre invité du jour, Nick Maggiulli, qui est l'auteur d'un livre qui s'appelle The Wealth Ladders, donc les échelons de la richesse. Investisseur, blogueur sur les finances perso depuis plus de 9 ans aux États-Unis de façon régulière sur un blog qui s'appelle Of Dollars and Data, donc il était un data scientifique à la base. Il a utilisé toutes les données dont il dispose aux États-Unis sur les individus qui arrivent à ces niveaux de richesse. Et il y en a beaucoup aux États-Unis, des millionnaires, multimillionnaires, milliardaires. C'est là où il y a la population probablement la plus grande, pour construire un framework, une structure autour de ça et comprendre en fait qu'est-ce qui fait que les individus sont à un niveau où ils sont par rapport à leur richesse. Et donc il a identifié plusieurs niveaux. Et on va en parler aujourd'hui. On va parler de diversification, de concentration, de type de leverage, de type d'actifs sur lequel on a des niveaux de richesse différents. On va parler aussi de ce qui rend vraiment les riches riches, le type d'actifs vraiment qui performe et qui rend la richesse même exponentielle. Aussi du type de comportement à avoir, de la relation entre la richesse et le bonheur et la satisfaction également. Et peut-être aussi le rôle du relationnel, du networking, qui tu vas voir est très important aussi dans ce cadre-là. Donc beaucoup de choses, je pense que tu vas pouvoir utiliser pour le marché français, même si c'est un marché différent, mais l'accès à la richesse est quand même le même. On était quand même basé sur la même, on va dire, la même type d'économie libérale qu'on peut voir aux États-Unis. Donc je pense que c'est très intéressant d'avoir cette conversation avec Nick aujourd'hui. J'espère que ça va te plaire. N'hésite pas à prendre contact aussi avec lui, et n'hésite pas à lire aussi son bouquin que j'ai lu, que je trouve vraiment, vraiment top. Et puis à me laisser des messages aussi pour me dire si ça t'a plu, si c'est le genre d'exercice. L'interview est en anglais, si ça te gêne, si ça te convient. Parfois je trouve que c'est bien d'avoir des acteurs vraiment différents aussi pour comprendre ces choses-là qui sont peut-être un peu tabous encore en France et où on n'a pas encore suffisamment de recul. Donc moi en tout cas ça m'a passionné et donc je suis impatient de te faire découvrir cette conversation dès maintenant. Allez, sans plus attendre, la conversation avec Nick, c'est parti. Hello, Nick. Welcome to Investors 4.0.
Thank you for having me on.
I'm really glad to have this conversation with you. Just to give you the context, it's a podcast mostly for investors who actually, I started the podcast saying, it's for mid-careers, professional, very busy life, family responsibilities who still want to move up and build, financial stability, but in a way that is sustainable and in a smart way. So I think we have a lot to discuss with you, and I think I'm really happy to have people discover your work as well, where you come from, and I think it's got great value for people listening to hear you. So
I appreciate that. Thank you so much. Thanks for having me on.
Can you maybe just bring some perspective about who you are and your background as well, that will inform as well your perspective and how you see things on the financial front?
Yeah, so I was an economics major in college, went to Stanford University. After I graduated, I went into something called litigation consulting, which is basically a company hires a law firm and then the law firm hires the litigation consulting firm, right? And so what I did there, I did a lot of data analysis, historical analysis on different industries to kind of understand, what happened over a certain period of time, calculating damages and things of that sort. And so I got very analytical. I learned data science really well. And on the side, I was really interested in personal finance and investing. And so in 2017, I said, hey, I'm going to start writing about this stuff, and I'm going to use my data background as a way to kind of write on it in a way that I hadn't seen before. And that was the whole goal with writing, was like, hey, analyze data in a cool way and then explain it to people and maybe who haven't seen the data or haven't seen this stuff. And so that's what I've been doing. It's been almost 9 years now. I've written one blog post a week since 2017, and I have not missed a single week. So it's been almost 9 years where I post like 480 something. So it's been going on for quite some time. And yeah, and so I've just been doing that ever since. As a result of writing and doing this for so long, I put together a book. My first book, Just Keep Buying, came out in 2022, and then this year I came out with my second book, The Wealth Ladder. And so it's been a exploration of understanding personal finance and investing. And my most recent book, The Wealth Ladder, is looking into wealth building, and it's a new framework for thinking about wealth building that I think is very helpful and can be helpful throughout your life. I wanted to write something that people would come back to over and over again, because you might be at a certain stage in your life now, but a decade from now, you're likely to be in a different financial stage. And so I wanted to write something that could kind of at least get someone to guide them regardless of which stage they're in.
Cool. And yeah, and personal finance and investment in general. I don't know about over in the US, but here in France, it's very, very emotional. I mean, links to emotions. And it's kind of rare to have someone really study the data of it. So, the extent that you did to come up with, framework and ideas more, from a data analysis perspective, not just from, oh, I've heard this guy did this and, that guy, so.
Yeah, I appreciate that. Yeah. And I think it's always going to be emotional for everybody. I mean, I'm not debating that. I talk about that in the book. There is a feelings based piece here. You can't just look at the numbers and just, make all your decisions based on that. But I do think there is something to having some data, because then you can at least, your emotion could be correct or it could be wrong in some ways. If you're like looking on social media and you're seeing people that have someone that seem like they have more than you, but it's like, you don't know if that's exceptional, if they're an outlier, if they're, they could have debt, that could be debt field. You don't know. And I think having the data gives you a little bit of like a base case so you can benchmark yourself. You can realize that, oh yeah, there are not as many wealthy people as I thought. Just because social media shows that doesn't mean that's the real world. And so there's a lot of times where our emotions are correct, but the data can actually say, oh, maybe that wasn't as correct as I thought. And so that's what I try to do.
Do you want to give a stab at explaining the wealth ladder, the framework, and the system, how you see it?
Yeah, so I did all of this in US dollars. I think you could probably use euros. It wouldn't be as helpful in Europe, only because there's so many like government programs and assistance, whether if you're paying for education, healthcare, all these things, they kind of change it a little. And I will address that at the end. But let me just do this in US dollars, and then we'll talk about how it's a little bit different for Europe. So in US dollar terms, there's 6 wealth levels. Level 1 is less than $10,000 in wealth, or less than 10,000 euros, you would say. Level 2 is 10,000 to 100,000 euros. Level 3 is 100,000 to 1 million euros. Level 4 is 1 million to 10 million euros. Level 5 is 10 million to 100 million euros. And then lastly, level 6 is 100 million, over 100 million euros, right? And so in the United States, in dollars, about 20% of households are in that first bucket, are less than $10,000. 20% are in the second level 2, which is 10,000 to 100,000. 40% are in level 3, that's about 100,000 to a million. And then 18% are in level 4. That's about 1 to 10 million US dollars, which is a lot of money. And then the top 2% is 10 million plus, which is an extraordinary amount of money. And so when I talk about wealth in the United States, I think most people are trying to get to level 4, 1 to 10 million. I think the reasons for that are multifaceted. I mean, there's this culture of being a millionaire and making it as a millionaire. Obviously, that's changed a bit because house prices have gone up, stock markets have gone up, etc. But in terms of thinking about this framework, a lot of people want to get into level 4 in the United States. I think you can live the same lifestyle as someone in level 4 in the US as someone you could be level 3 in Europe, only because the healthcare costs are much lower because they're already covered. There's a much better safety net. There's a lot of things that in the US you have to kind of cover yourself that you wouldn't have to cover in Europe. So you don't need as much money. If you get hit with this really crazy health scare in the US, you could be out hundreds of thousands of dollars, right? In Europe, that's not really the case, is my understanding. And of course, every system's different, every country is different, but I know like the healthcare in France is very good. So it's one of these things where you have to think a little bit about, okay, what are my goals? What's the lifestyle I'm trying to live? And then backing out from there. So I think like the ideal level of wealth in the US is level 4. I think the ideal level of wealth in most of Europe is probably level 3. So you still need to have some assets. You don't want to have nothing, but you don't need to have these extra layers of security for all these unforeseen events, because a lot of your guys' governments and economies kind of cover for these things. So that's kind of where I'm coming from, at least mentally, when I'm thinking about this type of stuff.
Yeah, and I know, of course, I mean, currently that's what's being questioned in Europe, in France in general, you know, how sustainable this system, healthcare system is. So I think it's kind of a jump into the future, just looking at that framework, and it's even more and more useful, I think, to take control of your own finances and consider that there won't be any, safety net there, which has been the case for our previous generation. But I think looking ahead, it's probably less and less true. So, what are the ways that you see, and I think you systemize that in the book, the different leverage or asset or tools, if we can maybe represent it as that would move you from each of the levels?
Yeah, so it depends where you start, but you can imagine that you could apply this wealth ladder framework, which is these 6 levels, to your spending. You can apply it to your income, and you can apply it to your investments, right? And so let's do investments because I think they're the easiest. So if you actually look at what people own, and once again, this is United States data, but if you look at like in levels 1 and 2, the biggest assets are usually people's cash, their cars, and by the time you get into level 2 and level 3, it's their home, right? That's like the biggest thing on their balance sheet as a proportion or as a percentage of their total assets, right? As you start to move up and starting to get into level 4, level 5, level 6, it changes, right? By level 4, the biggest thing is usually someone's retirement account, right? They're saving for the future because, once again, the US safety net isn't as good as other countries, right? So the retirement accounts are bigger, they have more stock ownership. And then by the time you get to level 5 and 6, what you're seeing is business ownership, individual business ownership. That is the primary thing that runs most of the wealth there. If you look at like people in level 6, especially, over half of their wealth usually is in their own business, right? A business that they own of some sort, right? And you can think about, like, you look at the richest people in the world, right? Whether you're looking at, Elon Musk, Bezos, Arnault, any one of these people, right? They're all have most of their wealth tied up in a business, right? And so that's what you see across the wealth ladder when you're thinking about investments, right? Okay, it goes from like, cars to homes to, businesses, right? That's kind of the transition. And in general, I like to generalize this as like, you go from non-income producing assets, things like your car doesn't produce income for you, unless you drive it for like an Uber or something, you're not really making income off your car. Your home's not really making income for you either, but then as you get into sort of like stocks, retirements, businesses, those are things that produce income that actually pay you, right? So there's this transition from non-income producing assets to income producing assets across the wealth ladder. So if you want to build wealth, one of the things I focus on, as I talked about in my first book, Just Keep Buying, is the continual purchase of a diverse set of income producing assets. So that's just one framework, but we could apply that to income. We could apply that to spending, or any way that anything you think your listeners would appreciate. I'm happy to expand on.
Yeah, because it's I think if I'm not mistaken, the just buying approach of basically investing, it's the way to move from level 2 to level 3 in your new book, right? It's mostly that tool that is used before you go into necessarily business and then scaling your business and etc. Right? It's probably the thing that you need to use on parallel to any other initiatives you might have, a business on the side or occupation or some sort, right? It's like the common denominator of across the ladders, right?
Yeah. So if you're going from level 2 to level 3, or from level 3 to level 4, Just Keep Buying is the strategy that would get you there, because the only difference is how long you do it for or how much income you have, right? If you do it for longer, you're more likely to get into level 4, have over $1 million, let's say, dollars or euros, right? You just do it for do it for multiple decades, you can get there. Or if you just have a higher income and you can save more, you can also get to level 4, right? That's the only difference, really. Like, the strategy is basically the same, but it's just the amount of time or the amount of money you can set aside to get there, right? Because in theory, you can get to level 4 without investing. If your income's high enough, if you're like a celebrity and you're making millions a year, you don't need to invest anything. You could have it all just sitting in a bank account and you would be, you'd be fine in that sense. But that's not what most people, they don't make, most people aren't making $1 million salaries. I don't assume that. I'm assuming people are making much more reasonable salaries, right? Let's say even a high income might be 100,000 euros a year. And so there's people who are making much less than that. And so it's like, okay, how do I get to level 3 or level 4? You have to take what euros you can save and then, invest that for the long term.
In the data you collected for the book, did you take into account the formidable period of growth that markets have seen? I mean, we've seen obviously COVID was a big impact. Crypto was there also in the mix. It seems like a lot of people got richer just investing in financial markets, which probably 2-3 decades ago might not have been the case, right? Is it something that you've looked at as well?
Yeah, so I didn't talk about this in the book because that's like a time trend within the data. So the Survey of Consumer Finances, which comes from the US Federal Reserve, they release this snapshot every 3 years, and they started in 1989. So I can go all the way back to 89, 92, 95, etc. And the most recent update was 2022, 2023. And so they're going to release the next update, which is 25 next year, probably September-ish in 26, right? So I'm looking forward to that, to seeing like how much it changed. But yeah, you are seeing already, and by 22, 23, you're seeing quite a big shift in terms of home equity in the United States. There's a lot more people that have more wealth, at least on paper, like their home's worth more, but they can't necessarily sell it and get that unless they want to downsize or move somewhere else, right? If all the other homes are more expensive. So it's been very interesting to kind of see that play out. But that's one thing we saw. And like crypto is obviously there, but it doesn't break out that fine. Like, oh, what's the asset allocation? We just know, oh, here's financial assets, and that falls under financial assets, which have also gone up. So, 401k assets have gone up. All these things you say are correct. And so we are seeing a lot of wealth that's maybe locked away that's going up, but also there's other financial wealth. But yes, you're completely correct that financial assets are basically at all-time highs within the United States, especially today. And it's only 2022. If you think 2022, 23, that was kind of a little bit of a lull in the market. So since then, obviously the markets have gone up a lot. So we're going to see even larger wealth gains in the next snapshot.
And it seems also that you seem to be quite agnostic in terms of type of assets that will get you up ladders. I think you're very cautious in saying, that you're not necessarily, advising on one asset or another to get you there quicker or whatever. You just, from the moment you have the asset, and in general, you just make observations. Is that something you wanted because, I mean, is that you're based on your true belief, or is it just safeguarding any potential backlash you might have there?
I think it really is based on my actual belief in that people do it in so many ways. Like if I kept seeing in the data, oh my gosh, every single person that got rich only bought stocks, like it would be pretty obvious, right? But like there's so many different ways people build wealth. Like some do it with stocks, some do it with farmland, some do it with real estate. And so we can go through and debate the merits of each one. And so I've seen it done across a lot of different asset classes. And so my catch-all is income producing assets. That's generally the thing that they own, right? And the most like that extreme wealth, the absolute richest people all own their own businesses. So I can say like with pretty high certainty, if you want to get extremely rich, once again, 100 million plus, you have to own a lot of equity in like one of your own businesses. Now, there are exceptions where someone's like maybe at a startup and like they get a lot of equity early, but either way, like they own the equity and then that business ends up being worth a lot of money. That's how that really plays out. So that's another way of kind of looking at it. And so I think just in general, I've tried to steer away from like providing, here's the exact recommendation I recommend, because markets go through cycle. And if that recommendation works out, you're going to look like a genius. And if it doesn't, everyone's going to call you an idiot. And it's like, that's not the point. The point should be like the general approach should be correct. And for me, that's like income producing assets are generally that. I can't say which ones because we don't know the future, and some are going to outperform, some are going to underperform. So I just know that this is directionally correct, but I can't give you a specific allocation.
Mm-hmm. And you base a lot of your observation on net worth, which is probably the easy as well, like big picture of where you are. And I totally agree with you on that. How do you look at income from that perspective? Does it like follow exactly the same kind of pattern that you see from net worth, or is it something like, for example, you're talking about Elon Musk, where I think in the book you say from one time to another, because the share price just soared. You have, his wealth has increased a lot, but it's not liquid, it's not cash, it's not income per se. How diversion? I mean, is it correct to look at net worth as opposed to income, or can we look at both individually?
Yeah, you can definitely look at both, and it depends what you're looking at specifically. And you're right, income is not net worth, but a lot of times, like what Elon Musk can do, if the market is stable, like he could sell those shares and then he can turn that wealth into income, right? Now, whether he wants to or as soon as he goes to sell, the market might say, wait, why is he selling? And then it could drop a lot. So there are reasons, there are things that can, in his particular case, that aren't as relevant for most of us. Like when I go to sell a share of a random stock, like the price doesn't change because I don't have any size or any brand related to that or any, so it's very different when most people go to buy or sell things. It doesn't really impact the price, but when you're a very popular figure and your net worth is linked to this asset and it's very public, it's a different thing. So in general, though, I think income is incredibly important. I think it's the thing that separates people across the wealth ladder. And so I actually have data in chapter 2, and I just want to give you the exact numbers here in terms of what we see in terms of earning up the wealth ladder. And so on page 25 in the book, I have this table that breaks out the income in dollars and then the wealth level. And so you can see that there. And basically, like the median US household income in level 1 is $32,000. So we could translate this to maybe euros, I think. In level 2, it's 47,000 euros. In level 3, it's 83,000 euros. In level 4, it's 196,000 euros. By level 5, it's 724,000 euros, right? And then once again, level 5 is 10 to 100 million. So you can see as wealth goes up, income tends to go up and vice versa. Obviously, this is going to be a little bit different because I know in Europe, salaries tend to be a little bit lower. So I don't think this would be completely, one-to-one matching. So that's why I use dollars here. And this is what the actual data shows. I don't have the data on like the European economy or just even France in general. But I think you're going to see a similar pattern. Maybe the numbers will be a little bit lower, but you're going to see those with more wealth tend to have more income and vice versa. And it makes sense because if you have more income, then you can save that income and it becomes wealth, right? And then that wealth can then produce income if it's invested, right? So it becomes a flywheel where wealth produces income, income produces wealth, and it just keeps building on itself over time. So that's, I think, the thing to keep in mind here.
Mm-hmm. And just returning on the asset type per se, I mean, we are quite big here on this podcast about property investing. Also, probably because in France you got a very accommodative mortgage system where you can really, with 10%, 20% of cash in, raise the remaining of your purchase with debt, fixed rate, mm-hmm. 20, 25 years in length. So it's very accommodative. Mm-hmm. But yeah, I was surprised to see that in the book, what you've analyzed in terms of the percentage of property asset for level 3, no, actually level 4, 5, and 6 is quite low. Actually, it goes up and then it goes down. How would you explain that?
Well, because if you think about it, I mean, this is your primary residence. This is not real estate in general. So I do break out primary residence ownership versus your real estate ownership. And the reason why is because as you start to get more and more extreme forms of wealth, like you're not going to have multiple homes. You know what I mean? You're just going to have the one home that you have, right? I think that's kind of the you know what I mean? Like you're not, if you have your home, okay, maybe you get a bigger home, but it's not like, oh, my wealth went up 10x. I want to get a 10 times bigger home, right? So usually what happens, someone owns a home and like their other wealth can keep growing, but they're not going to keep going and getting a bigger and bigger home over time. You know what I mean?
Yeah. Okay. Yeah. So US primary home. Okay. I thought it was also like a income generating asset.
No. It does. No, it does. So there is a breakout for that for real estate separately, which I do have in the book. And so that is and this once again, that's in chapter 3 here. So again, give me a second because then I can look and see. You can see, I mean, this is not as helpful, but this shows real estate wealth does go up into level 4 and level 5 as a percentage. You see it shoot up a little bit, but then by level 6, it's mostly people that have their own businesses. So it does go up a little bit. People could have a secondary home, things like that. I know that's common in France where people might have, maybe they live in the city and then they have a home up north or in the south or something like that. So that is possible, but it's usually once your wealth starts to go up even more, you usually have businesses and other types of things you own as well.
And when we go up the ladder, so clearly, owning a business is the key, right? It seems like, mm-hmm. equity in your own business or equity in general, seems like something you don't want to, you don't want to shed, right? You hold tight. One aspect that I found interesting as well is that, it seems like people rated to the top are not people who have, started a business and have equity on it. The business has grown, boomed, and boom, they're rich. It looks like they're more like piggybacking off of, buying a small share, selling, buying another share in another company, selling. Is that something
Hmm.
you've seen as well?
Um, I don't, I think in general, like everyone does it a little bit differently and how, in terms of how they, acquire wealth over time. And so I don't think, buying one share, selling it, piggybacking, that happens. And there are people that do that. I think it's really tough to do that, to pick individual stocks and figure out what's going to do well and what isn't. That's why like my approach is owning like a passive index, which owns a little bit of everything. So that all of those, you have a very diversified basket, and I don't need to pick the winners. Like the winners are going to be in there and the losers are in there too. And that's unfortunate, but generally over time, the winners earn more than the losers lose. And so I build wealth, right? Most people that own passive indexes build wealth over time. And so that's kind of the idea of how that works. And so that's why that approach has been successful historically. And I believe it's going to be successful going forward.
And of course, I mean, we talk about going up the ladder, but one aspect also is staying at the level we reach, right? And there is a risk always that of losing, of falling off the ladder, of the level that we were before. Seems like the culprit is mostly what, spending, would you say, or debt? Bad debt also can be seen as a way that you can basically like deteriorate your financial condition.
Yeah, it really depends where you start, right? It depends. So if you're in, let's take an extreme case. If you're in level 5 or 6, like the reason you probably fall down the ladder is because your business, which probably is most of your net worth, goes under or has a really bad event or there's fraud or something. And so most of your wealth just disappears basically overnight. That's how those people fall down the ladder, right? As you get maybe level 4, you can have bad investments, but if you're diversified, that's less likely, right? But then if you're in level 3 or 2, yes, it's probably spending. It could be other things, even things like divorce in the United States. It's like you could have a lot of money. As soon as you divorce, you might be in a certain level, but once you divide by 2, right, you can lose a lot of that wealth as well. So there's a host of different things, lawsuits, right? There's all these weird edge cases, at least in the United States, that can make you fall down the wealth ladder. But you're right, debt can do it. Overspending, all these types of things can do it, but it's figuring that out. Even an economic recession, something outside of your control. Once again, the investments go down, you lose your job, you have to start drawing down your assets. There's a lot of different ways this can play out, and so that's kind of where I think these types of things can occur.
Yeah, some triggering events, right? I mean, it's kind of hard to pinpoint, but yeah, spending probably in general. I mean, I can understand why as you go up, specifically, if you go up very fast as well. I don't know if there's a way of, how quickly you moved up the ladder, if it's a risk factor for you falling down quickly as well, because you just haven't adapted or have adapted too quickly your spending pattern. Yeah, it's just that good debt and bad debt. It's always a topic that people love to talk about. You were talking about vehicles and that's an asset, for example, that depreciates. Clearly, we can see that, if people just keep on buying something that depreciates so much, I mean, mathematically, you're going to increase your spending pattern and fall down. But that's more for people level 2, right? To do that.
It could be 2 and 3. I mean, I think we see it in different ways. Like in level 3, I think the way people can overspend is on their home, at least in the United States, where it's like they buy more house than they can afford. And in the US, we have a 30-year mortgage, right? And so you usually put 20% cash down, and then you have a 30-year fixed, right? And so, maybe, and early on is the riskiest time where that starts. But if that starts going, that's the type of thing that can happen.
Yeah, I'm always surprised how volatile the housing market is in the US, by the way, compared to France. I mean, I don't really know what's that for, but yeah, I mean, it's probably linked to usage or stuff like that. But yeah, it's very different, definitely.
Yeah, I think things have been financialized a little bit in the US and not as much in other countries, which is why the housing markets tend to be more stable. And the US used to be like that, but ever since, like the home is now something that is looked at as like an asset that's supposed to keep going up in value, and you sell it and you make money on it. And there's all these tax policies around capital gains. So you can get, in the United States, it's either 250 for individual, 250 per couple. And, you can have $250,000 in gains on your home and no taxes on that gain, right? Versus if I have a stock with $250,000, or I buy an index fund that gives me $250,000, I have to pay the long-term capital gains rate, right? Which is still going to be 15 to 20%, depending on, where your income is. So I think that's another thing too. We've kind of made it, we've incentivized people to really own a home and hope that the price goes up so you can take those gains.
Yeah, got it. Yeah, and I mean, what's your view on diversification and concentration risk? Because the view from over here is that if you, I mean, diversification is great, but there's been a big move from to go to very diversified portfolio, ETF, passive investing, and at the same time, if you want to walk up the wealth ladder, the wealth ladder, probably you need to concentrate on a few key assets, especially like business, if business is the one, or talent, and knowledge in the beginning, the level 1 or 2. What's the pattern you've seen in terms of when people diversify, and if they don't diversify too quickly, how could it harm like mobility across levels?
I guess it depends on your goals. I mean, if you know, oh, I want to be level 5, level 6, you want to have 10 million euros plus, like you have to concentrate. Like I can't imagine all the people that are like diversified with 100 million euros or $1 billion or whatever. They were not diversified at one point. They got very rich and then they sold some of that out and then they diversified, right? So they diversified after the fact. And so I think you can get rich and like for what most people want, I think what most people want to just live a good life. For most people's goals, you can get there without concentration. I fundamentally believe that. Like I have not been concentrated in any asset class and I think I'm doing fine. I mean, the most concentrated I am, I guess, is in like US stocks, not because I even own like my US stock percentage is like, I think 18% of my total assets is US stocks. So it's not even that much of my total net worth, but because I work at a firm that also has, that's like exposure to the stock market, right? Like my books, what I write about is exposure in different ways. So it's very interesting when you think about this, but like as a philosophy, I'm generally of the approach that like you should stay diversified and most people can live the life they want while being diversified. You don't need to concentrate. Now, of course, those people that really want that extreme wealth, yeah, you have to concentrate. So that's the only thing I would say is like, I don't think most people need concentration to live a good life and live the life they want. I think it's a bit excessive. I think in the United States, especially, people are very obsessed with wealth, especially at the extreme end, that it makes no sense to me. And they overlook other parts of their life, like their health or their friendships or their family. And it doesn't make sense to me because it's one of the, you can trade, you can't trade, money for family or health. It's not like it's very simple. Like, oh, I just had a heart attack. Let me just buy a new heart. Like that doesn't exist. Maybe one day it'll exist, but for now, like maximizing one variable and just completely overlooking the others I think is a very bad bet. And I think it's something that, too many Americans unfortunately do or focus on at least.
Yeah, I mean, arguably that's the reason why the U.S. economy and the U.S. entrepreneurship like mindset is so much of a model across the globe, right? It's the ability to be locked in and concentrated. But yeah, like completely agree with you. I mean, the problem is to know when to stop, and there is a moment. It's a balancing act, quite difficult to know. And there's a part in the book when you talk about the relationship between wealth and happiness. And I just reading it, I was thinking how difficult that sounds. Quite difficult to know exactly, because you do need to get to a point, and you want to go up the ladder, level 1 or 2 or 3, at least to be a point where money is not an issue, to kind of, and then to concentrate on non-financial, other asset or other activities. But in the beginning, you need to be obsessed by it, right? You can't just be saying, oh, from the get go, I want to focus on my wealth. Or you could, I guess, but it just would probably mean you're slower to go up, right?
Yeah, I mean, it depends once again what your goals are. If your goal is to get to the as high as you can on the ladder, then yeah, you have to make a lot of sacrifices. Like there's this famous story from Bill Gates. He didn't take a vacation for the first 10 years he was building Microsoft. He didn't take a single day off, not even a vacation. Like he worked every single day, Saturday, Sunday for 10 years. Like, and I write a blog post once a week for 9 years. I can tell you how much work that was. And like to be like, oh, I'm just working on this business every day for 10 years is like an insane level of dedication. But that's also why Microsoft was, at one point the biggest company in the world. And it's still one of the biggest companies. And Bill Gates is one of the richest people in the world. Like you start looking at all this and like, yeah, that's the level of dedication it takes. You need to do that for multiple decades to get to that level of success. Now, do you need, like, is Bill Gates happier than 99.99999% of people? Probably not, you know? So it's like, there's a lot of great things he's had because of it, but does that lead to a better life outcome? I don't know. And that's the debatable part. Like, I don't think he's happier than 99.999% of people, though his wealth is higher than 99.999% of people. So just something to keep in mind.
Yeah, yeah, no, but and as you pointed out early in the conversation when you mentioned like the net worth level, for each level, it seems like it's very exponential. Like this, it's not a progressive line. I mean, it's completely goes bananas from level 5. I mean, from 5 and 6, you even say like, you know, you put a quote saying, first, you don't know, you know, I think you said that the price of grocery store matter less, the price of a restaurant matters less. And then at the end, it's like, what price? What is price? It's just so fast, like the level that it goes to, that I'm wondering if even it can be deliberate for people to be thinking about those things as they just focus on it and they get there so quickly. I mean, I'm talking probably about the 0.001% of top performers, but it's probably a very fast route, right?
Yeah, and the reason I kind of made this what's called a logarithmic scale, or like a 10. There's like a multiplicative scale where like level 1 or level 2 is 10 times larger than level 1. Level 3 is 10 times larger than level 2. The reason I did that is because I think that's generally the size of the wealth move that has to happen for you to see a big change in your lifestyle. Like, someone going from 10,000 euros to 20,000 euros is not going to see that much change in lifestyle. Someone going from 2 million euros to even 3 million euros is not going to see that much change in lifestyle. But going from, you know, 0 to 100,000 euros is a huge change in lifestyle, right? So you can see, like, it's these big jumps that really make a difference, right? And so it's not like, you know, the marginal $1 million when you have $2 million isn't as impactful as that first million, right? Like, that first million matters a lot. The next million matters less. The next million. So that core idea is built into the framework. And I think it's how people actually experience money. You know, I don't think, you know, as I said, going from 2 to 3 million doesn't really change your life that much, but going from 0 to 100,000 completely changes your life, right? And so I think people know that. They understand it intrinsically. Getting off of 0 is probably the biggest step, is just getting off 0 and having some sense of safety. And then going from there, you're kind of just building more and more redundancy. And it's, I mean, at some point it's like even overkill. It's more than you'll ever spend, but that's kind of how I think it works.
But you point something very interesting. Is I feel it points to the rewiring of the brain, almost like, you know, this reward of getting there finally and living it. And it's so short lived because you adapt so fast that you don't actually see satisfaction from it. It's kind of linked to wealth and to happiness as well. And I mean, how you maybe personally you think of adapting, you know, to the level of rewards that you get, you cross those levels, and not to be always, or not to let your mind just keep looking up and therefore not really enjoying the success that you've had, or you know, having passed that goal that you set yourself for such a long time.
I think it's very easy to play games with your mind to say, oh, well, I wasn't thinking about, like, you can make up excuses for why you need more money. It's always easy. Like, oh, well, what if this happens? I was never thinking about that back then. Like, let's say when I was 23, I'm like, oh, once I hit 1 million, I'll be set, right? Like, I could have said that, you know, but then it's like, oh, now I have a wife and we're going to have a kid and we might want to have 3 kids. And like, oh, 1 million's not going to be enough. Now I need 5 million. You know, you can keep playing this game. And even once you get to 5 million, like, oh, well, what if this happened, right? You can like keep inventing reasons to need more money. It's like actually very easy. It's one of the easiest things you can do. But I think ultimately you have to, like, at some point be like, okay, do I actually need this? Or is this just me being like a little too fearful or thinking through every eventuality? I don't know. And so it's a personal thing. I can't give you the answer to that. Every person's going to have a different feeling about money. And so getting to enough is going to vary a lot. And for a lot of people, and most people, it's so funny when you ask people like, how much wealth would you need to have to like feel satisfied? For almost everyone, it's the same. And it's like 2x, like whatever you have now, just multiply by 2. And everyone's like, oh my God, if I had 2 times what I have now, I'd be fine. But like by the time you do have the 2x, you might not even feel that way anymore, which is the funniest part. So it's interesting in its own right.
Yeah. So it looks like we're doomed, right? Just have to.
Yeah. Just keep doubling.
Yeah. I want to talk to you about networking and relationship a little bit, because you mentioned it interestingly in the book in two levels. You mention it as the main level from level 1 to level 2, right? When you basically don't have anything but people who can trust you and teach you stuff, right? But also at the other end of the spectrum, I think you mentioned it for Zach Zuckerberg, sorry, the CEO of Facebook, who delegates a lot, and when he has an idea, implements it so much faster just because he has the team, the crew, the people, and he doesn't do it himself, and yet he reaps the reward, right? So it just sounds like it's network might actually, and relationship might actually be the key asset, right? All across.
Yeah, for a lot of people, like it's an incredibly important asset, especially when you're starting out, because we look at like wealth as like, oh, how much money's in your bank account? That's just one type of wealth. As I said, it's, because it's very measurable, it's very easy to focus on that, right? Like it's very hard to, as I said, to like see the other types of wealth you might have, but like having relationships is a huge form of wealth, and it's not going to show up in a bank account necessarily, right? And so having people you can rely on, oh, I can contact this person, I could do this, or whatever it is, that type of stuff is very valuable, and people, I think, undervalue it systematically. And so knowing that it's how valuable that is, that's something you can focus on as well. And so yes, whether that you're just starting out or whether you're now building a team, you have a business or something, that those people are the people that are going to help you move up the wealth ladder even further.
Yeah, it's quite. I mean, it's probably the cheapest asset you can buy as well. I mean, it's not quantifiable, of course, but it's. I agree with you. I think it's broadly very underutilized. And then in the same vein, I mean, just education. I know you have a background where you talk about it in the book, where you come from, a working class family, and you've risen yourself through. You've had the chance to go to a nice university and have a nice education. Would you do the same if it was to do it all over again? How do you see the education part of where you maybe start as level 1, level 2, level 3?
I think it's incredibly important. I wouldn't have changed anything. Of course, I'm saying this now, like looking back, it's kind of hard, but I wouldn't have changed anything about my education. I think if I could go back, something I would change, I would have focused more on health earlier. Not that my health's bad or anything, but like, I think it's incredibly important. And as much as I started to focus on it when I was like 27 years old, around the same time I started blogging, I probably could have focused on it much earlier. And so I think that's something that I would have done differently. But outside of that, like, I think education is so important because it's like it compounds on itself. It's just like an asset, like any other asset, right? Like me knowing some fact or me knowing a set of skills, I can use that skill again. And now once I like put it into a book, like, oh, I learned something, I put it here into a product, and now that I can sell this product, and this product's out there earning money for me while I'm on a podcast with you, while I'm sleeping, like while I'm doing whatever. And so I think that's really the unlock that starts to happen, is when you're like, oh, wow, I can not only learn something, but I can take it and I can put it into a product, and then that product can be sold and make me money. So I think there's other ways of doing that. And of course, I'm trying to sell it because I think it's helpful. I really believe it's helpful. I mean, of course, as much as I want to make money as much as anyone else, but like, I really believe these things can help people and help people think about their decisions, right? And it's not like, oh, it's going to give you the answer to every single question, financial question you're going to have, but it's going to hopefully guide you toward the area where you can look deeper and do more research. And that's the point of the wealth ladder. Like, I'm not going to give you how do you start a business and how do you grow a bit. I don't know how to do that, but I know that that's the thing that those people did. And so maybe you need to understand that and then dig deeper into that category. And I think a lot of people overlook that. Like, where should I even be looking is the question, or where should I start is the question. And that's what I'm trying to answer with the wealth ladder. It's like, oh, you need to start, given where you are, you need to look at this, right? That's kind of the point of the book.
Mm-hmm. Yeah. No, absolutely. Maybe one last question for me, and just refreshing point is how you think that, AI could reshuffle a little bit, like the reasoning we've been talking about, if it's really transformational or maybe not as much as what we could think, or how do you think about, the entry of AI into those, this reasoning basically?
I think it's going to fundamentally transform the economy. It already has in many ways. A lot of junior jobs, like, internships, basic research internships, things like basic programmers, like all these things have been kind of automated away by large language models by AI. And so the question is like, what are the skills I can learn that won't be automated away? Is that sales? Is that things that are credentialized? Is it, I know in the legal field in the US, like there's been a lot of pushback against AI. So I don't think AI is going to creep as deep in there as we thought, as we, normally thought it would have. But it's interesting to kind of see how this is playing out. And I do think you need to, I don't have the answer. Like no one knows how everything's going to play out, but the joke I hear, not the joke or the phrase is like, AI is not going to take your job. Someone that uses AI is going to take your job. And so I think using these tools, understanding how they work, understanding where their drawbacks are and where they're not going to help you is going to be incredibly important. So I would embrace it rather than like shun the technology altogether.
Yeah, definitely. Same as you pointed out, keeping your eyes open on exactly what makes you richer financially, be very pragmatic, same thing, be aware of how you can use those tools. So perfect. Circle.
Exactly. Yeah.
Awesome. Nick, thank you very much for your time. It was great. Talk to you. Where could people maybe reach you? What's the best place?
They can find me on Instagram at Nick Maggiulli or on LinkedIn at Nick Maggiulli. And I try to answer every DM. So if you send me a message on there, I will try to answer it as quickly as I can. So appreciate your time and just let me know if you have any questions. And just want to say thanks. I love France. My wife and I went to Nice for our honeymoon a few months ago. So that was very fun. And we always it's our third time in Paris now. So it's been very fun together.
Wow, great. Yeah. Awesome. Cool.
Yeah,
thanks a lot, Nick. Take care.
Yeah, thank you.
Si tu as aimé cette conversation, tu vas également aimer l'épisode 225 avec Rob Dix, qui est aussi un auteur anglo-saxon, anglaise pour le coup, qui parle de la relation à l'argent et qui est aussi très intéressant. Je te le recommande si ça te plaît, si les discussions en anglais te repoussent pas trop, voire t'enthousiasment. Ça sera avec plaisir, je pense que tu vas passer un bon moment. Bonne découverte et bonne écoute.